A couple principles of investing questions. Warren Buffett at some point has said, it turns out to be true of Motley Fool data as well. Warren Buffett has said that if he had never sold a stock since he was 11 years old, he would be a lot wealthier and Berkshire Hathaway shareholders would be a lot better off. We looked at all of our investment results of the Motley Fool. If we had never recommended a sale, the overall net returns would be better, particularly if you factor in capital gains taxes and the time and energy and emotion of trying to figure out when to sell something and buy something else. Does that align with how you think at Vanguard? Do you think the best thing that somebody could do if they came in at 25 years old with their first Vanguard account in their 401k or in an IRA, if they just bought and said, well, you know, I saw this interview and Jack said I should just never sell that no matter what happens out there in the world, just keep adding money and never sell is a good principle?
Sure, that's right. Now you want to be sure you're on a broad-based index fund. And I would say traditional index fund, you can buy a Vanguard ETF, exchange-traded fund, for the S&P 500. It's part of the same identical portfolio, the 500 portfolio we have here, which is largely owned by traditional index fund holders, and to a smaller extent, maybe 20%, owned by exchange-traded fund. Same product, more or less the same price. And if you hang on to it, it doesn't matter which you do. So you hang on, and I'll give you one little example. The lawyer for the underwriters in our initial underwriting in 1976, one of the greatest flops in the history of Wall Street.
The underwriting or the lawyer?
The lawyer. No, the underwriting, excuse me. Good question. And we had a 40th anniversary lunch the other day, and not too many of them left. They don't seem to be quite as hardy as you know who. And he said he bought 1,000 shares. He wanted this tragic underwriting, tiny.
It was like an $11 million
$11 million
take, and what were the expectations?
Well, what he said was, you know, we were sure we could do 250 million, and then we got a pretty good chance at 200 million. It looks like 150 million is in the bag, and if we reach just a little bit more strongly, we'll get to 100 million, and 50 million ought to be duck soup. And I know we can get 25 million, and the check comes in, and it's 11.3. And so he felt badly about it. He'd made a nice fee, I guess, from it. And so he bought 1,000 shares at $15, put in 15,000. And he brought his statement to the meeting.
That's great.
He's held it ever since. And he has paid any taxes out of his own pocket, income taxes. And at the outset, we had a few more capital gains taxes, but not very many. And I don't think we paid a capital gain distribution because we don't sell anything for probably 20 years now, something like that. And I'll ask you, $15,000 in 1976. What does he have today?
Okay. I'm going to say that he has $15,000.
I know you're supposed to be asking the questions.
I'll say he has 106,000.
Wow, what a great guess.
I'm way off. Darn it. No, of course I'm way off. I'm not even close. No,
$903,000.
Yes. Yeah.
$903,000.
Yeah. We're going to edit that out.
Edit your part out. Keep
I'm going to
part
say
in.
900, give or take 3. Yeah, that's
brilliant. It's the best guess I've ever heard.
Well, I remember reading about Shelby Davis. I don't know whether you knew Shelby Davis Sr. Or
He was a big giver to Princeton University.
Okay, yes, okay, your alma mater.
Insurance stocks.
And yes, he had started with 50,000, and he came up with the principle: I should never sell because the worst thing you can do is lose a huge winner.
Yep.
Saving yourself from losses is minus 100 at worst, and that's rare. But if you miss the huge, great long-term winners, and he turned $50,000, and he did 24% a year. Of course, he used margin. But he died with $900 million from that 45 years later. So,
well, I feel really sorry for him. You know, think about it. It could have been $1 billion.
Exactly. Got so close. What about risk? How do you assess risk? If we're now saying, oh, put your money in, let it ride, add to it over time, start with 15,000, you find yourself 40 years later, you're going to have $900,000 or something approximating that, depending on how the overall market does in the next 40 years. But what about larger risks? What risk could reasonably threaten that in the next 40 years? Or are you telling your grandchildren in their 20s now, just go with this game plan?
Well, I do for my grandchildren. They can change it when they don't really know how much money I put away for them over all these years. And I always put it in balanced index fund. 60% S&P 500, or total stock market, I should say. and 60% total bond
60,
market.
60 and 40.
40%.
You said last time we talked that anyone watching could put all of their money into that one fund and make it their sole investment throughout life.
Now, it's conservative, and it protects you against your emotions, because when the market goes way down, stock market goes way down, the bond market actually usually goes up a little bit under that circumstance. So investors have behavioral problems, and they panic if their account goes down 50%. An account like this probably goes down 32 or 3%. So you don't get exposed to the worst of it. There's no question that a 100% stock portfolio will do better in the long run. I mean, that's just the numbers. As stocks will return over the long run, not every 25-year period, but probably 3 out of 4, stocks will return more than bonds. They will be the highest returning investment because they have a higher risk. Now, what is risk? Let me tell you what it is not. It is not volatility. We use volatility to measure risk. You know, if the market goes up, let me say, or down 25%, and you own the market, that's what you do. If you want to reduce the volatility in a balanced fund, you know, you maybe go up or down 15%. And if you want to get an extremely aggressive fund, maybe up and down 40%. But it's symmetrical and fairly symmetrical. And so that's a way of measuring, but it's a short-term thing. In the long term, the risk is that you may lose one hell of a lot of money. If you started buying stocks in 1919 or 1920 or 1918, you were doing fine through 1929, and then you lost 90% of your money in an all-stock portfolio.
And it took you another 15 years to get back to even or something.
Yeah, actually a little more than, just about right, 15 years in mid-40s. And so those kind of risks are big risks. And the risks that we can't measure, there are risks that come from things like, what is the probability that our society will collapse? What is the probability that with all the undercurrents that are going on in American society between the haves and have-nots, and the haves, the superior, larger races and the minorities, those gaps are very wide, and I'm deeply concerned that we may get in some real trouble, and that's why I describe myself as so conservative that I'm liberal. I want to protect our society, and therefore I want to protect those segments of society that haven't been treated fairly to the best of our ability. And then there are the known risks, like nuclear war, worldwide disease, plague kind of thing, religious uprisings, the things that we know about and worry about today. And then, as my fellow Princetonian Secretary of Defense Donald Rumsfeld says, those are the known unknowns. And what about the unknown unknowns? And of course, since they're unknown, we can't comment on that, about that.
But none of those unknown unknowns, or none of those big risks, cause you to change your investment approach, I guess, because the assumption is if the market goes down 90% on the Bogle family portfolios, that there are so many other problems in the world, it's probably not going to be a make or break thing for you that your stock portfolio is down.
Well, no, as a wise man once said, if there's nuclear war, it won't matter a hell of a lot whether you own stocks or bonds. It's gone. Society is gone. It's frightening to think about. And I think that given the enormity of these kind of risks that I've described and the unknown risks that we really don't know, we don't know what they are, which is kind of frightening. But invest you must. As I've said to people, probably on television or interviews kind of thing, the one way to assure that the value of your retirement plan is zero is to not invest a penny, and zero is guaranteed. So you have to put your money to work. In the extreme circumstance, even cash is not going to help you. It's not going to be any good if the nuclear bombs start going off. It's a frightening, fragile world that we live in. So you can sit and worry about it every day, and in certain respects, if you like to worry, it's a good thing to worry about. But you kind of have to get on with your game, prepare for the future, and hope that those extreme risks don't come home to roost.